What is the first thing that comes to mind by looking at these charts? We're looking at a few different currencies, but all against the Japanese yen. In other words, all against a safe haven. So with that in mind, clearly something must have gone wrong here, like a risk-off event that triggered traders and investors to pile into a safe haven like the Japanese yen. And that would be the correct thinking, because precisely that was when recessionary fears in the US picked up steam in early August, and that was triggered by one specific piece of data, which was an awful recessionary ISM manufacturing number from the US. Now, the reason I'm showing you this is to allow you to see an example, a real example of what happens when markets enter into growth concerns or recessionary risks mode. So let me simplify the whole context. Basically, the currency market is made up of two baskets of currencies, high beta and low beta. High beta currencies are the Australian dollar, the New Zealand dollar, the British pound, the Canadian dollar, and emerging market currencies. Now, these are currencies that are considered attractive when global economic growth is looking good. But when things turn south, everyone runs out of high beta currencies into what we call low beta currencies, such as the US dollar, the Japanese yen, the Swiss franc, and to some extent even the euro. Now, these low beta currencies are what we call safe havens. Obviously, with the exception of the euro. The euro is not a safe haven, but still, you need to keep in mind it's a low beta currency. So you will see the euro outperform the likes of the Australian dollar, the New Zealand dollar in risk-off events. For instance, here is exactly how Euro-Aussie moved in early August when those recessionary fears that we mentioned earlier started to take hold. So despite the euro not being a safe haven, or despite Euro-Aussie having nothing to do with the US data, still, the sentiment made a lower beta currency like the euro more attractive than a high beta currency like the Australian dollar. So you can start to understand how this concept is really important to understand, because you need to be conscious of how the market moves in different risk environments, because it affects everything. It's not just about safe havens, it's not just about high beta, it's about a combination of everything. So knowing the role that currencies have to risk sentiment gives you a broader understanding of where to be positioned in the various macro contexts. For instance, in early 2023, 2 US banks went under. Obviously, that's not a good thing for investor sentiments, and in fact, the market went into full panic mode. Investors and traders saw banks going down, and the story in hindsight was fairly contained and limited, but at the time no one knew exactly what was going on and what could have been the consequences, how spread out the spillovers could have been. So the market precautiously feared a much larger global crisis if more banks were affected. So what they did, they rushed out of risk assets into safe havens like the Japanese yen and the Swiss franc. So while high beta currencies like the Australian dollar and New Zealand dollar got hit hardest, safe havens like the Japanese yen gained. Here's, for instance, AUD JPY in that context. Here's, for instance, a short that we took on AUD JPY in that context, all because of this risk-off. So in this type of risk-off environment, you dump high beta currencies and you pile into safe havens. Now, if you remember already in another video, I've already mentioned the US versus China trade war back in 2019. That's not a perfect example, because here's the New Zealand dollar, a high beta currency, against what? The Japanese yen, a low beta currency. And you can clearly see two trends, bearish in the first half and bullish in the second half. So bearish during what? Escalating geopolitical tensions between the US and China. Why? Because traders in that context favor a safe haven like the Japanese yen rather than a high beta currency like the New Zealand dollar. But instead, the opposite happens in the opposite context. When tension cool off and things move in a more positive direction geopolitically, in this example, NZD JPY bottomed and it started to trend up accordingly. This is not random. That's not price leads first and fundamentals follow. That's not the debate here. The debate is not on whether the chart predicts the fundamental developments or whatever. The debate here is that simply the macro context allows you to understand and to know exactly what's going on. That way, you know exactly where you should lean into, in which direction you should lean into. Risk off, favor safe havens. Risk on, favor high beta. Now, Here's where it gets even more interesting. To give you some context, here you can see AUD JPY overlaid with the S&P 500 in orange. See the correlation? Looks like the same thing, but they shouldn't be the same thing. I mean, AUD JPY is AUD JPY and the S&P 500 is the S&P 500. Why they move the same? The answer, obviously, risk sentiment. When sentiment is positive, stocks go up, and so does AUD JPY. When sentiment crashes, so do both. Why? Because the Australian dollar is a high beta and the yen is a safe haven. So what's the point here? The point here is that risk sentiment is very often the missing piece that traders don't get about fundamentals. They understand interest rates, they understand hikes, cuts and all that, but very often they miss the risk context. And whether it's currencies, stocks, bonds or commodities, risk sentiment ties everything together. So get it right, understand it, and you'll be able to position on the right side of the market more often than not. The key here, though, is obviously being well updated on what's going on outside of the charts. So, geopolitical events, economic data, everything that matters for risk sentiment. It's important to be up to date with it and to see when things are about to take a direction, when the market is clearly being driven by a certain type of sentiment. But at the same time, here is where it gets a little bit more complex, because you need to be aware of not being flip-flopped left and right at every minor change in sentiment. You have to be able to recognize the big shifts. I mean, a small miss in a piece of data is not necessarily recessionary. A geopolitical headlines from the Middle East is not necessarily a big risk-off event. You have to be able to put things into context and to evaluate the event to see if it really matters for the sentiment or not. Obviously, that takes a bit of experience, of course, but that's how it works.